And on today's show, how 412(e)(3) plans can offer huge deductible contributions. Part 5 of this week's series on 412(e)(3) retirement plans with nationally recognized 412(e)(3) expert Nick Paleveda, MBA and attorney. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, day 5, Nick, are you surviving?
Yeah, just surviving. Right.
We'll talk about surviving again on Amazon.com for all of you aficionados who are anal retentive and analytic. This is the anthology, and this is huge. I mean, you teach this all over the United States.
I do, right.
And this is the 3rd publication, so this has been going on for a long time.
That's right.
And Nick, you were telling me, we said this at the beginning of the week, I just want to reassert this. You just came back recently from practicing in front of the Supreme Court of the United States on some kind of tax issue.
Right. I actually had a case before the Supreme Court, working with one of the major law firms in the United States, Ropes and Gray. So they were actually doing oral arguments. I was doing supporting, and it was my case. So it was a great experience to be in front of the Supreme Court justice.
You know, we have our distribution network where this show goes out to. You have a huge distribution that between your newsletters and everything. How big is your distribution and a lot of your information?
We have about 28,000 people right now that we distribute to, and we have about 44 pension consultants around the country that we work with on a daily basis doing these defined benefit pension plans.
Is the 44,000 and the 28 the same people or no?
44 is part of the 28,000.
Okay,
the 28,000 are mainly professionals that receive our newsletter that goes out.
Well, I think at the end of yesterday's show, we had a lot of people just, well, first of all, they were surprised and stunned, as I was when I first learned about this a couple years back. But more than that, this is a huge, I mean, based on what's going on, Obamacare 2014, think about this, Obamacare in 2014 either had new taxes or tax hikes, 20 new taxes or tax hikes, and everybody's looking for shelter, looking for tax relief. Now, this is, again, down the code, 412(e)(3 section of the code of defined benefit pension plans, and the one we're talking about is fully insured. This is down the middle code. This isn't some, hey, we're sitting on the ragged edge of some kind of code dispute or gray area. We're hoping that the private letter ruling works. No, we're not talking about any of that. But when I'm talking about these numbers, they seem so large. Let's just talk about, when I think about 6-figure contribution deductions, I mean, this makes a SEP IRA look like it dwarfs it so much. It makes it look so small. Talk about this number.
Yeah, well, first of all, let's realize that in 412(e)(3, there's been no adverse tax court opinion ever published in this area. So like I say, if you stay in the tried and true area, you're pretty good to go. Now the deductions are much larger, and people want to know, why can you put in 100,000, 200, or 300,000 into the plan? Well, you have to go back to...
Well, excuse me, just before you go too far. You said I was in the 250 range. 300. How far up have you seen this go? I'm just curious.
350 and more, actually.
For one client.
One client. Now, here's the reason why. Remember, in a defined contribution plan, you're doing a percentage of pay. So let's say the thing is, if you have $100,000 income, the maximum you can deduct is 25% of pay or $25,000. In a defined benefit plan, you don't go off of a percentage of pay. You're doing benefits when you go to retire. And your maximum benefit today can be a guaranteed lifetime income. Notice the word guaranteed. Lifetime income of $210,000 a year for the rest of your life. Do you know how much money you need to pile away to get $210,000? Now, why do you have to pile away so much today? Low interest rate environment. Remember, when interest rates were 10%, okay, and some of the people have been around remember that time.
I have.
Well, $1 million would produce $100,000 income. So you need $2 million, we'll give you $200,000. You're good to go. You only need $2 million to replace that. Now let's run the interest rates down, not from 10% to 1%. Your $1 million gets you how much? $10,000. That's poverty, okay? So what happens, because of a low interest rate environment, you have to fund more into your plan. So you can put $3.9 million into your plan. Okay, now you're age 55. You have to get $3.9 million into your plan by the time you're age 65. You only have 10 years to do it. Assuming you earn 1%, that's close to $390,000 a year.
Now, is that going to change every year?
It does, because the thing is, the interest rates can change, and also what happens is there's COLA adjustments. Last year was 205, now you can fund up to 210. So it keeps moving. So every year, when you're working with your plan administrator, you want to take a look at your plan to make sure you're on target to get your
Did I just hear you correctly? I want to make sure I heard this. There sound like there are two competing issues. One is interest rates, and the other one is the COLA.
Cost of living adjustment.
So if I have my interest rates ticking up,
right,
then my contribution may shrink. But
That
then
is
again, I
correct.
may add it back on again because I get the COLA.
That is correct.
All right.
That's basically
Okay.
what happens. Interest rates could tick up, but the COLA goes up, and all of a sudden you're back in the
So it's
same
almost
contribution
the
number.
same numbers.
You're basically back in the same number, but it's not unusual. So here's what is unusual. Realize when we're talking about tax rates, we know they're all going up for the high income tax earner. But do you know the corporate rate is like 35%? Do you know the effective corporate rate is 12.1? And do you know why? Well, like General Electric has 400 tax attorneys like myself helping them out to make sure they manage their taxes. But you're a doctor, I can tell you they don't have 400 tax attorneys working on their tax bill. And so what happens is the doctors and dentists never get the tax advice to say, why don't you set up a pension? Even medical economics said 95% of these doctors should have pensions, and they don't. It's just the way it is. Right now there's I call it a supply-demand mismatch in the market. The people who really know this, the enrolled actuaries, there's only 4,000. The people that need this, about 3 million people. And that's what we're sitting with today.
When we come back from the break, we're going to talk a lot more again about the contributions, kind of redux and summarize the whole week, because this is a huge issue that could be beneficial for your practice. We'll be right back in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Nick, I'm almost crippled in my thinking of having a $350,000 deductible, and with Obamacare, some of the things I've talked about just on that issue, rates going up for the affluent, people are looking for legitimate, conservative understanding of the code and how to apply it to their life and their own personal pensions. Everybody's looking for these numbers, and you kind of shocked me early on in the week by saying a vast majority, possibly, of our fiduciary market of CPAs and maybe some tax attorneys may not be up to speed on these kind of plans.
That's correct. And here's also the reason why, after working in this area 12 years, I'm going, why doesn't everybody know about pension plans and retirement plans? Well, did you take a retirement plan class in high school? No, they didn't offer it. How about in college? Guess what? They don't offer it in college. What happens if you're like me? I got an MBA. Did they offer it in the MBA programs? I check around the whole country. Almost no MBA programs will offer it. You go to law school. They don't offer a retirement planning class. Until you get a graduate tax degree, then maybe you're offered your first retirement planning class. So here we have 300 million people in the country. Some of them are going to retire, the baby boomers, 70 or 80 million, and they've never taken a retirement plan class in their country.
And didn't you tell me people like yourself, I mean, there's what, less than 4,000 people that even play in this arena?
Well, there's about 15,000 total when you consider all the professionals, the ones that do all the actual work, about 4,000. And so what happens is there's, like I say, a supply-demand mismatch. We have a huge group, 300 million, uneducated people in the retirement planning area that don't even know the basic rules. And what we're discussing today is really the basic rules in how you fund a pension plan.
Well, when I'm reducing the summary list of this whole week's discussions, we're talking about saving it's tax efficient. This area of the code is so tax efficient against 401ks, it blows it out the water. We're talking about expense loads, admin expense loads of a 412E3 fully insured defined benefit plan. Wow, I got it all in one shot. Those numbers are huge. We're talking about comparing, there is no real fund rate based on annuities. I mean, there's no charge inside for this, right? I mean, you're talking about an expense load. So you're comparing that to a mutual funds expense load. You're talking about the statement of information, the AUM fee. There's all these efficiencies that are happening here. And now we're adding on top of this, we could have some serious headroom, some in tax bracket deduction here issues. So this is all, when I start putting this all together, there's some serious balance sheet items here.
Yeah, that's right. There actually is. There's a lot of, we call it demographics, working in your favor of setting up these plans. But remember, it's for people that can contribute usually more than $50,000 a year. Because if you're doing less than $50,000 a year, you can use a profit sharing plan, usually to accomplish the same result. When you go over the magic number 50,000 or 52 today, you can't put that amount into your plan. So you have to look at defined benefit. And defined benefit plans, remember, we're looking at everything as how much money do you get as a lifetime income when you retire. And they were designed years ago for people like doctors, lawyers, and people that make their money in their later years, in their 50s, with a short time to fund for their retirement, giving them an advantage to at least get some money in for their retirement So when they reach age 65, or we've had people set them up at age 70. That's another thing people don't know. You go, 70? I didn't know you could set up at age 70. Yes, you have 5 years you can fund at age 70. Our oldest client today is age 75. 5 years, he's already retired at age 80.
Let's talk about, if we come back, let's say after these weeks of shows, we're dipping our toe in the water. This is kind of an introduction on the show all this week. How long would it take to put together a very elementary workshop to really introduce the mechanics and put a marketing mantra? What am I looking for? What kind of businesses are good to look for this? How can I go trolling, prospecting for new clients in this area? How long would it take us to put together something like that, do you think?
Well, it depends on how deep you want to get into this stuff. Like I said,
how about at least enough to begin to engage and then have you partner with that?
Yeah, I mean, we can spend as little as much time as you want to this area. I mean, we're right now in the basic area. We go from this all the way to the sophisticated gray books, which enrolled actuaries look at. Most people don't even know what a gray book is.
Well, just the word gray sounded a little mystifying right there.
It's IRS Q&A based on certain actuarial issues. Okay, so this area can be quite deep and complex, and also can be quite simple. But here's what you're looking at usually for a client who has more than $50,000 a year that they can put away systematically for their retirement. Because like I say, less than 50, go look at a profit sharing plan. More than 50, the profit sharing plan breaks down. And so you're going to need a defined benefit plan. So if they can put 50,000, 100,000, 200,000, or even 300,000 a year away each year for their retirement, that becomes an ideal person for a defined benefit plan. And it works in an area, it's a space that your profit sharing plan 401k can't get into.
And again, we're talking about the basic two products of annuity and life insurance. They have to comply with the law. The enrolled actuary is going to have to okay the whole life, whatever document we're going to use for that.
Right.
They're based on the contract numbers, not on the current company assumptions.
That's correct.
And this unisex issue.
That's right. Right.
Okay.
No, it's guaranteed.
Okay, so we have an inventory. It's quite small and limited. We're not talking about a dozen carriers or so that can really actually fit the bill for this.
That is correct.
That's what I like about it. This is the first time I can say this is kind of an inverted thinking on my part. This is the first time I say, wow, the inventory is small enough, I might be able to actually conquer it.
Right.
You know?
Right. Yeah, it's a really small group. Like I said, this is a small industry, 4,000, 15,000 people, but it's a huge in terms of numbers. 18.7 trillion today is sitting in our retirement plans right now. 18.7 trillion. Do you know that's enough to pay the national debt and have trillions left over?
Don't give them any ideas, Nick.
I don't want to tell them that, but you can do that. And so what happens is, like I said, this area is vastly underserved. Why? Because we're talking about 100-person and less groups. The large actuarial firms don't even want to work in that space because their enrolled actuaries can't make enough money working at that. They want 100 people or more. So this small group, they need more people to help people plan for their retirement. And I can tell you, after doing this for 12 years, a lot of doctors, the lawyers, architects, engineers, high-income people don't even know this is available for them. So they're paying progressively more higher income taxes. And as I tell them, why do you want to give the government money for their retirement plan when you can take it and put it for your retirement plan?
Well, I'm all over that mantra. Well, that's our show for today. Remember, before moving forward with any ideas you hear on our show, especially this week, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view all our past episodes at downtobusiness.ashbrokerage.com. So remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you next week.